point by point how much it costs various aspects of the silver industry to create silver, how much it costs to recycle silver, how much it costs to produce silver as a byproduct of copper production. There are already reports of cargoes ready to deliver that are outside the Gulf that are trading at substantial premiums to spot. If this problem continues, closure of the Straits and the hostilities between the U.S., Israel, and Iran, I'm afraid we could expect much higher.
The Japanese own, close to $1 trillion of debt. The dollar is based mostly on debt, taking into account the Fed's balance sheet, which is mostly debt, and the Fed is the issuer of the dollar.
I'm a systematic saver in gold. I'm a systematic saver, and I maintain liquidity in a variety of currencies, not just the US dollar. When I bought my silver, silver was sub 20, and I bought it because there was a lot of hate around it. The precious metals bull market is always led by the fear buyer, which is to say the gold buyer. And when the generalist investor comes down into our little ghetto, the precious metals market, the leadership switches from gold to silver. The fact that silver had moved from $20 to $75 suggested that it was no longer hated. So I came to understand how value was created, which is to say I developed a very deep working knowledge of the oil business. I've since developed a deep working knowledge of the mining business and a reasonable working knowledge of how value is created in timberland and agriculture, which means I have a head start over most competitors in understanding what value really is. I could walk your wife, if she had the willingness to listen, point by point, through how much it costs various aspects of the silver industry to create silver, how much it costs to recycle silver, how much it costs to produce silver as a byproduct of copper production, how much primary silver production costs. And while I wouldn't get exactly right the inflection point between price and value, I could make a case to her that the silver price had to go up. Whether she would be willing to listen after the trauma of watching your portfolio fall that much is a different question. But ultimately, that's none of my concern. On the oil markets, I think I have something to say there. I've been in that business for a very, very long time. And I suggest that half of what you say is accurate, which is to say that there was substantial above ground inventory, particularly in countries that could afford to have one. The Chinese, the Japanese, the United States, and we've run off, as an example, now 70% of the U.S. Strategic oil reserves. The Chinese are less inclined to tell us what they've run off, but obviously a substantial amount.
A commodity's price can look irrational until you understand what it costs to replace the supply underneath it. According to Rick Rule, knowing production, recycling, and byproduct economics creates an informational advantage most market participants never develop. That matters because inventories can temporarily suppress prices while simultaneously making future supply more fragile. Investors watching only spot prices may miss that structural tension entirely. Next, Rick Rule exposes how depletion of strategic inventories can quietly transform a temporary shortage into a pricing shock.
But the second thing that shows us is that markets work. In the United States, when the pump price doubles, we curse, usually the oil companies, as opposed to cursing the governments who we should cuss. But then we fill up the tank and drive on because we can afford to. Higher oil prices are an inconvenience to us. We don't have a supply problem, we have a price problem. But in Sri Lanka, in Malawi, in Myanmar, in Bolivia, what happens during periods of high oil prices is that cars get parked. Markets work. And the cure for high prices is always high prices. What the market has ignored about this shortage is the fact that prices, particularly prices above $100 per 6 million British thermal units, destroy demand. And in places where they can't afford these prices, demand is being destroyed in real terms. The third part of what you said is, I think, also true, which is to say, if the difficulties in the Gulf persist, if no de facto armistice is reached, we will not be pricing oil in anticipation of shortage. We'll be pricing oil around the reality of shortage. And if you begin to ration oil by price, rather than the anticipation of that, you price it very much higher. There are already reports of cargoes ready to deliver that are outside the Gulf that are trading at substantial premiums to spot. And if this problem continues, by problem, I mean the closure of the straits and the hostilities between the U.S., Israel, and Iran, I'm afraid we could expect much higher oil prices.
High oil prices do something Wall Street rarely emphasizes. They destroy demand long before consumers admit they are in trouble. This is where Rick Rule's thesis shifts from shortage headlines to economic reality, because affordability determines consumption more brutally than forecasts do. If Gulf disruptions persist, markets could stop pricing hypothetical scarcity and begin pricing actual rationing. That distinction could hit households through energy costs and inflation. Next, Rick Rule unravels why soaring prices themselves may hide the deeper damage occurring underneath demand.
Not as high as many people think, because people who are in different circumstances than the three of us on this call will simply not be able to afford oil. And that will absolutely moderate demand. The impact that you talk about on the Japanese is very real. Japan doesn't have access either to the storage capacity of China or to any domestic supplies. And the consequence there is that Japan Inc. is seriously constrained. And Japan Inc. is guilty of what in Canadian terms would be called an own goal, in the sense that post-Fukushima, they shut down their nuclear fleet, which was an important part of energy security in Japan. The consequence of that is that they have to generate way, way, way too much baseload electricity, by burning liquefied natural gas, which they have to import, which is a real challenge for them. As to the impact on the Japanese yen and its potential to destabilize the global financial situation and its ultimate impact on the gold price, I'm going to leave that to the two of you. I wouldn't want to burden your listeners with my mistakes around FX.
Okay, that's completely fair. So, I mean, to complete that thought, and then I'll pass it over to Phil, is that with just what I'm thinking is that the dollar infrastructure that has been overlaid on the planet since the victory in World War II and stuffing every central bank with a bunch of dollars, and therefore the dollar becoming the reserve currency, is intimately dependent on the Japanese own, close to $1 trillion of debt.
Oil shocks become dangerous when nations discover they cannot simply buy their way through them. Rick Rule notes that Japan's energy dependence creates a vulnerability extending beyond fuel prices into currency stability and financial markets. The overlooked issue is that higher energy costs can simultaneously weaken consumers, pressure importers, and destabilize currencies. For investors, that means an energy crisis could migrate into monetary markets faster than expected. Next, Rick Rule exposes the hidden connection between Japan's energy dependence, the yen, and broader financial stability.
And the dollar is based mostly on debt, taking into account the Fed's balance sheet, which is mostly debt, and the Fed is the issuer of the dollar. So I'm taking this as a logical, positive Austrian economics perspective. So I personally don't see the dollar surviving if the yen keeps falling, because then they'll have to sell treasuries, and then the interest rates will go up, and then the debt will become unsustainable, and then it becomes valueless, and then the dollar, being based mostly on debt, will die with it. And I think that's where we might disagree going forward, or where our thought paths may diverge. I'm not sure, but Phil, do you want to take it from here?
Yeah, I wanted to ask a quick question. So, when silver was going absolutely vertical, you started selling your silver, and I thought to myself, oh, he might regret that. But you were absolutely correct, Mr. Rule, and I was the chump holding the bag of half devalued silver. So, I want to know what inspired you to sell that, and is there a pattern you would see where you would say, "Oh, this is dollar devaluation. I'm going to hold on to the metals. I don't want more dollars at this point."
Three responses to that. I save in gold, not in silver.
That's
I
fair. Yeah,
consider
yeah. Okay.
I consider gold to be insurance. Well, I consider it to be wealth. and I'm a systematic saver in gold. I'm a systematic saver, and I maintain liquidity in a variety of currencies, not just the US dollar.
The real currency risk may begin when a falling yen forces global investors to question the safety of dollar-denominated debt. What Rick Rule's argument suggests is that currency weakness can become a Treasury market problem if Japanese institutions need liquidity. But that chain reaction is not guaranteed. Markets can absorb enormous distortions longer than investors expect. The crucial issue is whether monetary stress eventually overwhelms confidence. Next, Rick Rule reveals why his approach to gold differs fundamentally from his approach to speculative silver.
We could talk about that later, but I save in gold. I speculated in silver. When I bought my silver, silver was sub 20, and I bought it because there was a lot of hate around it. And in my life, you learn to love hate. The fact that everybody was expressing so much hate for silver suggested to me that they had already expressed their preference in the market, which is to say they sold it before they dumped on it in internet discussion groups.
Mm-hmm.
And I knew from past experience that a precious metals bull market is always led by the fear buyer, which is to say the gold buyer. And when the generalist investor comes down into our little ghetto, the precious metals market, the leadership switches from gold to silver. So I thought that would happen. I've also learned that in my speculative account, which is where silver was, when the reason to own something goes away, the position has to go away. You can always find excuses to hold a position. And you find excuses to hold positions that are running, which is precisely the positions that should be sold. The third lesson is that anytime I see a hyperbolic chart, up or down, I take the backside of the trade. These hyperbolic trades, the Canadians call them hockey stick graphs, is a discussion themselves worth talking about. The backside of a hockey stick is just as steep as the front side, but it's a lot less fun if you happen to be long. And so when I saw the hyperbolic up move in silver, I needed to ask myself if my thesis, my speculative thesis, was still intact.
A hated asset can become dangerous the moment investors stop hating it. What Rick Rule notes is that he treated gold as wealth while treating silver as speculation, giving each position a different exit discipline. The key signal was not simply price appreciation, but the disappearance of the original reason for owning silver. Investors often reverse that logic and invent new reasons to hold winners. Next, Rick Rule reveals why a parabolic chart can be an exit signal rather than proof of endless upside.
The fact that silver had moved from $20 to $75 suggested that it was no longer hated. If my reason to own it was that it was hated, I needed to convince myself of a new reason. And the fact that it could go higher after it doubled or tripled was not sufficient reason. Could is a really lousy word in investing and speculating.
So I want to push back on one point. If the dollar itself becomes hated, so the dollars are just littering the streets and nobody's bothering to pick them up, that's not a time to jump in on dollars.
I share your perspective on the dollar. I would listen. I've proven to myself that I'm not a good currency speculator. What I do, I maintain liquidity in a variety of currencies. I try to pick currencies that I live my life in. So as an example, I invest a lot in Chile. So I have some Chilean pesos, but I live in the US. And if you're looking at fiat currencies, I like the Doug Casey quote that the US dollar is the worst fiat currency in the world with the sole exception of all the others. Or the suggestion that the dollar is, again quoting Doug Casey, the prettiest mare at the slaughterhouse. I suspect that I will be living my life in dollars for a substantial period of time. So I have to accommodate myself to the deterioration of the purchasing power of the US dollar. I know perfectly well that if I buy a US 10-year Treasury yielding 5, that I'm not making 5, I'm losing 3.
A triple in silver does not prove the next triple is coming. It may prove the original thesis has already played out. This is where Rick Rule's thesis shifts toward disciplined skepticism. Because could go higher is not an investment thesis by itself. The same principle applies to dollars and treasuries, when nominal yields conceal purchasing power losses.
You know, buying pieces of paper with dreams printed on them from liars is not a really rational activity. And so I've seen what a manic market in resources looks like. And I've been in financial services, including retail financial services, long enough to know that when a sector gets over hot, the last part of the cycle, the blow off part of the cycle, where the narrative matters much more than the utility, is something that will occur. I've seen in the 45 years that you all describe as the doldrum, I've seen 4 white hot mini markets, including the January market that we just had in silver. It's odd that every reason to own silver that propelled people to buy it for $100 in October existed 5 years ago when I bought it at 20. But most people who don't study, most people who prefer to feel as opposed to think, don't adopt a narrative until the narrative has been proven by price. But when the narrative has been proven by price, the narrative is less valuable, which is to say every advantage that silver had at 100, it had at 20. The difference is at 20, taking the risk made some sense. Speculating in the narrative made some sense. At 100, the narrative was more attractive because it had been proven, but all the juice was out of the squeeze. The nature of most human beings is that because price information is easy to gather and value information is hard to ascertain, people pay slavish attention to price without paying very much attention to value.
Silver can become most dangerous precisely when everyone finally understands why they wanted it. Rick Rule notes that silver's fundamental advantages existed at $20, yet investors waited for $100 before believing the story. That reveals the hidden trap. Rising prices create confidence while simultaneously reducing the margin for error. When narrative replaces valuation, late buyers may be paying maximum prices for yesterday's opportunity. Next, Rick Rule exposes why the same fundamentals that created the opportunity can become irrelevant once speculation overwhelms value.
I believe that money is made on the delta between price and value. Not that you ever get it right. You just have to get it more right than the moron next to you. And that's been, responsible for whatever success I've enjoyed. That sort of discipline and the understanding, even if I can't ascertain exactly what the value is, that value matters more than price.
So my final question here, and then I'll pass off to Rafi to close out if he wants to. How did you, your ability to buy what is hated, that is emotionally difficult. Like I also bought silver when it was 20. I whaled into silver when it was about $20. I wrote it up to 120 and I'm still riding it now at 60. That was, if it was to collapse to $14, let's say, just absolutely, crap the bed, I would have, my logic would say, I need to tell my wife we need to go and cash out our savings and go buy a whole bunch of silver, just back up the truck and get as much as we can. But she would be screaming at me. She said, "What are you talking about, Phil? You bought it at 20, you didn't sell it at 120, and now you want to buy more at 14?" So that would be a very reasonable, normal human reaction that I would have to try to override and say, "No, babe, you don't understand. It's going way higher in the future."
The hardest investment decision is often buying what everyone else has already declared dead. According to Rick Rule, the real edge comes from recognizing the gap between price and value before the crowd does. His hypothetical $14 silver collapse exposes the emotional contradiction. The same investor who refuses to buy weakness may chase strength after a massive rally. For wealth preservation, discipline matters more than conviction. Next, Rick Rule reveals why hated assets can become the best opportunities precisely when your instincts scream otherwise.
How did you teach yourself to react in this way? And how do you convince other people in case it goes to 14 and talk to my wife?
Um, Two good questions. I learned to do it in the beginning by not doing it. In the decade of the 70s, believed the Club of Rome narrative that the world was going to run out of commodities, that markets didn't work. Uh, the big thinkers in the decade of the 70s told you that by the year 2000, 100 million people a year were going to die of starvation, that oil was going to be $200 a barrel, all that kind of stuff, that markets didn't work. And as a young man, I believed that. It was an important part of my narrative. It was where I was making my money. I identified as a blue-eyed sheik. 1982 changed a lot of things for me. I learned that markets did work. And if they worked on the downside, they had to work on the upside. That's when I decided that in my life, because what I did was natural resources, which are capital intensive and cyclical, that my I had three choices. No, two really. I could be a contrarian, which is what I became, or I could become a victim, which is what I was. And being a contrarian was a much more attractive alternative to me than being a victim. I had also, in the decade of the 70s, immersed myself fairly deeply in the oil and gas business.
The most expensive lesson in markets is discovering that your own narrative can bankrupt you. What Rick Rule is highlighting is how the 1970s taught him that commodities could be misunderstood from both directions, especially when investors confuse conviction with evidence. The critical shift was accepting that markets work even when prices move violently against popular beliefs. For savers, that mindset can prevent emotional decisions when assets collapse. Next, Rick Rule reveals how understanding cyclical industries turned contrarian thinking from a theory into survival.